Hi, everyone. My name is Peter Mitchell, Managing Partner at Kingsgate Capital Partners, and welcome to Five by the Fire. These short, sharp podcasts are designed to provide allocators and influencers of capital a deeper understanding of the investment managers we represent, as well as their strategies. In this episode, we have Blair Reid, Senior Portfolio Manager for the Reservoir Global Multi-Asset Credit Fund that we affectionately call GMAC, which is sub-advised by Blair and his team at BlueBay Asset Management, headquartered in London. I thought today, Blair, rather than ask you a number of questions, I thought we'd have a little bit more of a conversation and discussion, particularly poignant given, A, all the things that are going on around the globe, but also the idea that you are in the fifth day of a 5-day road show where we've traveled the country. We've had over 30 meeting with over around 55 people. So it certainly has been interesting. It's been hectic. It's been torrid, and all the things that you have had conversations with from the allocators and influencers of capital, I've found extremely interesting. So I thought, again, rather than go through all the questions, I thought, well, maybe why don't we just start with a couple of quick ones. How did you find this week, and how did you find the tone from the allocators of capital? Are they worried? Are they excited? Are they nervous?
Well, thanks for having me back, Pete, and I think they are all three of those things. It is Friday. I'm not sure you've got me at my best after 4 days of talking to a lot of clients, but it's been a really interesting week to see a whole spectrum of views from clients on where this might finish, what type of products clients are interested in and think might find not only some protection but some opportunity in the environment going forward, and just a really whole range of possible outcomes. So it's been a great time to come in one way, because you always want a lot to talk about, but one might say I've been blessed with too many things to talk about, and investors like some type of surety, or fairly narrow distribution of future outcomes to have some confidence. And that's not the environment we're in today. So I've been talking very much really about how we manage funds in an environment where things are really pretty uncertain.
Mm. Yeah, I mean, one of the certainly the lead question that we received by a lot of the people was around the tariffs. Now, I think they are whatever they are. We read them in the papers. I'm not really sure what it's all settled on, where it will settle. But I found some of the comments you had certainly around a consumption tax. I thought that was very, very interesting. But more broadly, just maybe get back to the beginning again. Your thoughts on the tariffs, and where are we, and where do you think it's going to go?
So I think one thing I commented on this week was harking back to my very first day of studying economics at Macquarie University, what seems like 1,000 years ago. And the professor commented to, I think, about 900 day one students that the thing about economics is it is 50% accounting and 50% astrology. And they're going to teach us the 50% accounting, but you've got to understand a lot of these things don't apply in the short run. So on tariffs, we're pretty confident Trump is very aware. One would hope that in the long run, high-level tariffs aren't great. Aren't great for innovation in the country that levies them. They're not fabulous for productivity. But there's nothing to say they can't be used as a pretty blunt instrument for negotiating some type of outcome in the short run. So in the short term, it's probably been a little bit more chaotic than many, including us, might have imagined. Nonetheless, this concept of a fairly low-level global tariff we think is probably here to stay for some time. And the comment around the consumption tax, or the link, is, if you look at the underlying numbers and the flows, if you think about what would happen if the US at the federal level levied a consumption tax, you kind of get a similar thing to a low-level global tariff. So in many ways, the administration in the US needs a way to pay for the income tax they've given, the income cuts they've given, income tax, and also the ones that they've promised and not yet delivered. So that's one way to do it. The end game on tariffs, or at least a principal component for Trump, is really the US-China trading relationship. And that there's a whole myriad of outcomes that is possible there. Probably the worst one, probably for asset managers and investors, is a very high tariff stalemate between the two that's extended. It would affect supply chains, it would affect demand and sentiment, certainly in emerging markets. So I can see that being more detrimental if that drags on. And I think over the course of probably the next few months, I think we'll get a much clearer steer on the likely speed of some type of, I guess, not final state, but medium-term state as to where tariffs are. And the comments that many of investors have made to us, and which of course is true, is Trump's in terms of timeline is on a pretty short leash to the midterms. China has the luxury of time, so it'll be very interesting over the next few months to see how those tensions play out. And in terms of our view in the short run, I'll come on and talk about the portfolio. In many ways, you just have to hunker down and try and make yourself as immune to tariff volatility as you possibly can.
Yeah. I mean, the last time you were here in sort of early 2024, and actually even, I think it was actually mid 2024 when we were chatting about the election, and you and the team had in fact predicted that it would be a Trump victory. And then as you got to the end of the year, commentary from him and his team became much more boisterous, if you will. And so from that point, did you start positioning the portfolio for some of the dialogue that he was articulating to the masses, or did this come as a surprise to you?
So it didn't come as a surprise, I think, to us or many investors. I think the administration was pretty clear as to what they intended to do. In terms of pre-positioning, I think us, along with many investors, tried to minimize our exposure to sectors that would be most impacted, particularly by extended Chinese tariffs. So you tended to move out of pharmaceuticals. You tended to minimize retailers that were dependent on imports from China. And I think that was a pretty straightforward playbook for many investors. And so I think that's stage one. We did, others did, and I think that's worked pretty well. The more difficult and prosaic problem is what to do about the volatility day to day. So once the numbers started coming out, and after Liberation Day, it was for a few days there hard to keep track of exactly what the numbers were. We had security. So there's two ways of approaching it. From our type of portfolio, which is a pretty broad, diversified selection of bond ideas across the globe, a lot of it's sub-investment grade, but upper quality sub-investment grade. You're at first, so stage one is you are thinking from the bottom up. What exactly do I own? Are these securities going to pay me back in a whole raft or spectrum of possible outcomes? And really, what is the strength and robustness of these businesses? So that's kind of the first thing you do, and we're happy with where we are on that, and we sold a few things. You're then really thinking about managing the portfolio in a macro-driven environment from the top. And the primary consideration, really, how much risk are we running? So unfortunately and unexcitingly, as I've explained to a lot of investors this week, we're neither taking a lot of risk nor taking a little. And we're kind of in the middle. And we're happy with being in the middle. So it's a difficult environment to run a lot of risk because we don't think we have a strong enough forecasting horizon to justify that. Equally, when we look at numbers and surveys and we panel investors, most people are pretty happy with where things are at the moment. We do expect a degradation in a lot of the indices and certainly sentiment indices coming out. But those things aren't bad. So you also don't want to miss out. So we've certainly had this theme of high quality carry or high quality yield, where we try and position the portfolio to be as robust as we possibly can, but also seek as much income or yield as we can and try and minimize that drawdown. So it is a little bit of an art. We have a lot of tools and a lot of risk system, but ultimately you're trying to balance those things up and kind of weather some of this short-term volatility and stay the course in the medium term.
Yeah, certainly a lot of the questions where if I step back 5 years ago where there was no income to fix, it's a much different tonality now in conversations, and people are certainly very, very inquisitive as to the purpose of a bond and its place in the portfolio. Did you get a feel for everyone trying to figure out about emerging markets, what's going on with high yield? There was a feeling about having a diversified portfolio that was global in nature was certainly a better selection or a better choice of their positioning for capital rather than specific asset classes. That's something that I got out of it. Was that something that you felt as well?
I think there's a number of elements there, Pete. I think the primary comparison for a lot of investors for what we manage, which is, as you say, a diversified set across high yield, emerging markets, converts, AT1s, basically anything that's liquid or has to be daily liquid in the product. There's a comparison to equities, and I think what has been encouraging, certainly so far this year, is really the lack of correlation between what these markets have done and the equity markets, which have been whipped around a lot more. So certainly volatility adjusted, the bonds have behaved incredibly well. And the underlying inclination of why that might be is in my world, one of the attractions is most of the securities we own have contractual cash flows. If the entity who's issued the bond or the security doesn't default, I can tell you exactly what day they're going to pay me exactly how much money. And that's a real attraction in an environment where there is quite a bit of uncertainty. And I guess coming back to what I said earlier on some of the Trump tariffs, in the short run, this is back to the astrology part of economics probably than the science. In the short run, you can certainly use these tools, and there's nothing to say they're not effective, but it can get away from you when it fundamentally changes consumer sentiment, and can be hard to get back on track. So we have to try and trade all these things off, and for a lot of investors, it is thinking about a more diversified approach. And I think one thing that certainly resonated with investors this week is, being based in London, as I am, it's a global portfolio, but overall exposure to the US is generally about 20 to 25% of the overall fund. It does have a truly global focus, and a lot of investors have US-based managers. That home bias for the US manager, I think, will become ever stronger over the next year or two. And I think the global managers are of interest to a lot of investors because they're not necessarily going to get such a US-centric view of the world. And who knows what might happen. But all I can say is a diversified portfolio with some aspects and some investments in the US we think makes a lot of sense. But that diversification away from reliance on the US, I think, is a theme investors have certainly latched onto.
Yeah, that's definitely it. Certainly, and you feel quite small living in Australia. You're realizing the importance of why fish in the pond when you can fish in the ocean. So, and I think that's my last comment, everyone. That is it for the podcast today. I just want to say thank you very much to Blair for some great insights, and I love the feedback from the clients. I think everyone was very, very engaged and particularly interesting a time without a doubt. So really appreciate it. And for our listeners, if you want to find out more about GMAC, please get in contact with the Kingsgate Capital Partners team or head to our website. Thanks for listening to 5 by the Fire, everyone, and thank you very much, Blair.
Thanks, Pete.